Alrighty, well, welcome everybody to our monthly Money Life webinar. I'm Jim Allen, President and Chief Financial Planner here at Anchor Bay. Um, if someone wouldn't mind, give me a thumbs up that you can see the slides okay and that you can hear my voice okay. All right, looks like we're good to go. So our topic tonight is planning in an uncertain tax environment. So we've kind of been working on this presentation for, you know, probably since October. And, it could have gone either way depending on the outcome of the election, both for president and for Congress. Now we have some clarity regarding, the administration, the makeup of Congress, et cetera. So we thought we would at least give you a little bit of a debrief about what we think is going to happen this year and some of the strategies we may want to incorporate um, based on what we think is going to happen. So we'll go through that. Um, there'll be plenty of time to ask questions at the end. So if you have questions, you can put them in the Q&A feature, and we'll answer those at the end. This presentation is being recorded. And so we'll have it posted on our website, anchorbaycapital.com, probably sometime next week. We'll let everybody know when. So if you have to jump off or you want to re-listen to it or you know somebody who maybe would benefit from listening to it, it'll be available next week. So let's kind of dig into the agenda here. So we're going to talk about the status of the Tax Cuts and Jobs Act because as planned at the end of this year, that Tax Cut and Jobs Act is scheduled to sunset and go away. And so we'll talk a little bit more about what we think is going to happen with it now. And then we'll also talk about various planning strategies for 2025. A lot of these are strategies that we've implemented in the past. And at least at this point, it looks like there'll still be strategies we're going to continue for the foreseeable future. And then finally, it's not related to tax necessarily, but there was a recent law change regarding Social Security. So for those of you who are maybe work in the government, first responder, worked a teacher, something like that, and you worked both inside and outside the Social Security system, you faced some penalties that people that worked in Social Security didn't face. These have been repealed, so we'll give you an update about what's happening with the Social Security Fairness Act towards the end of the presentation. So let's start with the Tax Cuts and Jobs Act. So there was a lot of different things in it. These were also called the Trump tax cuts. They've been in effect for about 6 years now. So one of the biggies was that it doubled the estate and gift tax exemption. So virtually 99.9% of the population didn't have to worry about gift and estate taxes. The one that's kind of put a whammy on most of us here in California is what's called the SALT cap, state and local tax cap. And so with that, what you have is your property tax, your state income tax, your DMV fees, all of those kind of things, what are called SALT taxes, were capped at $10,000. And so for a lot of people, in Orange County where I live, $10,000 doesn't even cover the property tax, let alone, your state income tax. And so that was kind of a painful one for a lot of people that lived in high tax states. They also doubled the standard deduction. So many people, who used to itemize between the SALT cap and the doubling of the standard deduction no longer itemize. We just take the standard deduction. I'll show you how that works in a little bit. The top tax rate was lowered from 39.6 to 37. And then there were also expanded tax brackets. For example, there was a 24% tax bracket. And if the Tax Cut and Jobs Act sunsetted, all of these things would go away. One of the other majors is that regular corporations, what we call C corporations, their rate was lowered to a flat 21%. For those companies that were not C corporations, to kind of offset the lowering of the tax rate for C corporations, there was something called the QBI deduction for pass-through entities. And then we also had 100% bonus depreciation. So there were a lot of features for both businesses and individuals in the TCJA. And as I mentioned, right now it's scheduled to sunset 12/31 of this year. And absent some change by Congress, that will happen. In terms of what we think is going to happen now, is that more than likely it won't sunset. Obviously, the TCJA was created by President Trump along with the Republican Congress, and so they're on board with keeping many or most of the provisions in TCJA. The question will be whether they get enough people to go along with it to be able to do something. So our best guess at this point is it's likely to be extended in some form. Don't know if it'll be extended in whole. There are some popular things in the provision. And then also the extension of the TCJA will create massive budget deficits. These were major tax cuts without really any offsetting revenue raisers. And so, it would make what's already a very large budget deficit worse. And so even on the Republican side, there are, deficit hawks who want to cut government spending and reduce the deficits that aren't going to go along with continued tax cuts. So part of the proposal to kind of offset those deficit increases would be President Trump's proposed tariffs. In our opinion, both from a tax standpoint and an economic standpoint, we think tariffs are not a good idea. Essentially, those increases that get passed on to companies in foreign countries just get sent back to the U.S. in the form of higher prices. And so tariffs don't accomplish what the intended result is. It could trigger trade wars, which has happened in the past, et cetera. So we shall see whether it's a combination of just extension of what we have. Maybe there's some other proposed revenue raisers, and maybe the idea is proposed tariffs are going to be used as a revenue raiser, and then we'll see whether it has the intended effect or not. One thing that is probably likely is the proposed elimination or increase in that $10,000 SALT cap. Even though President Trump created the SALT cap and Congress passed it, it's highly unpopular with just about anybody. And so our best guess is at a minimum, it'll get increased. They've kicked around anywhere from $20,000 to $50,000 for the cap. I think they would like to eliminate it. But again, if we're going to have all these other continued tax cuts, revenue has to be raised somewhere. And so it very well could be in that, yes, we'll get an increased SALT deduction, but it probably will still be capped. The other thing they want to do is to make the corporate tax rate permanent at 21% or maybe even lower to 20%. Again, that's a tax cut that normally has to be offset with some kind of revenue. But if they did that, then things like the qualified business deduction and bonus depreciation would be made permanent. And then more than likely, the current estate tax exemption will continue and the current tax brackets will continue. So all in all, extension of the TCJA for most people is not a bad thing, other than the SALT cap. I mean, if that could get fixed, the other things are positive from a taxation standpoint. Okay, so assuming that we're going to continue some sort of strategy under TCJA, what we're kind of calling TCJA 2.0. A lot of the things we've been doing over the last few years, why TCJA has been in effect, and we've had these lower tax rates and lower tax brackets, we're going to continue those. So if we had anticipated TCJA sunsetting at the end of next year, we would have done probably more things this year to kind of even maximize more marginal tax rate strategies and things like that. But at this point, I think we may have, for the most part, status quo. So kind of the things we're going to want to look at, and we'll talk about these in more detail in the next few slides, are maximize marginal tax rates. So we have that 24% bracket. We have a top 37% bracket. Let's take advantage of those while we have those. At some point, more than likely, these rates are going to change, but let's take advantage of them. The other thing that we always look at there are certain financial, what we call cliffs, where if you earn $1 more than that cliff, it triggers additional taxation. I'll show you some examples of those. Maximizing tax favored vehicles, and that isn't just necessarily keep plowing money into your 401k and IRA. It means balancing tax diversification between Roth IRAs, health savings accounts, 401ks, IRAs, all of that. And then finally, there are some strategies for those of you that own businesses that we'll talk about. So strategy one, avoiding tax cliffs. So these are some of the tax cliffs that we're talking about. So if you're not familiar, there's an additional 3.8%, what's called net investment income tax. So this is a 3.8% tax on your net investment income. So your dividends, your interest, your capital gains, annuity distributions, rental real estate, those kind of things. So if you're above a certain threshold, then it triggers this additional tax. And I'll show you an example on the next slide. Then you have something called income-related Medicare adjustment amount, or IRMA, where if you are income's at a certain level and you go $1 above, all of a sudden your Medicare premiums are increased. So Medicare premiums are essentially income tested, and the more you make, the higher your Medicare premium. And they're cliff threshold. So you go $1 over, now you're in the next threshold. And then finally, Social Security benefits. So Social Security benefits have some favorable taxation. They may not be taxed at all. They may be taxed at 50%. They may be taxed at 85%. And $1 over, again, can trigger taxation. And so the idea with avoiding these tax cliffs is, can we make sure whatever we're doing is keeping you below these thresholds where we may trigger some additional tax because we've exceeded the tax cliff. For example, the NII, as I mentioned, it's a 3.8% additional tax on investment income. So not wages, it's interest, it's dividends, it's capital gains, and all that. So it kicks in at $200,000 for a single filer and $250,000 for a married filing joint filer. So if you exceed those thresholds, now your 15% cap gains bracket, for example, becomes 18.8. And so above these thresholds, any income above that, you're paying that additional 3.8% tax. So, and planning wise, I mean, if your income is well above this, there's not a lot we can do in terms of getting below the threshold. But if we're around that threshold, then we want to come up with strategies to keep you below it so that you don't aren't subject to the NII. Or often, if you're going to be subject to it, then are there things we can do to minimize the income that you have to pay tax on? So for example, let's say you're a single filer and you're making $200,000 of income. You're not subject to the NII. If you make 210, that extra 10,000 subject to the NII. So maybe what we look at is, okay, well, let's increase your 401k contributions to get you below that $200,000 threshold. So that would be planning strategy one, is what can we do to get you below the threshold? If we can't accomplish that, then it's okay. Are there things we can use to not be subject to the NII? And examples might be municipal bonds, or it could be putting money in a deferred annuity and let it grow and not pay tax on it, or it could be putting into life insurance cash values, things like that. So this one's, if you're over the threshold, you're over the threshold. There's not a lot we can do, but certainly if you're kind of around that threshold level, there's planning strategies we can use to minimize the NII tax. All righty, so the next one is IRMA. And so if you're on Medicare, you pay for your Part B, which is your normal healthcare coverage, and Part D is your prescription drugs. And as I mentioned, these are means tested, and I'll show you a chart. And the way this works is because 2025, we don't know what your income is going to be, so they go back to 2023 to determine your 2025 premium, because people haven't filed their 2024 return at the start of 2025. So they go back to your 2023 return. That determines what thresholds you're in for IRMA. Now, if say you're in one of the higher IRMA thresholds, but it's you've stopped working, we can request a waiver if you've had a life triggering event like you've retired. And so then we can say, hey, that income from 2023 isn't reflective of my 2025 income, and we can maybe get that IRMAA threshold reduced for you. But here's brackets from 2022. So if we look at an individual, if you're below 91,000, you paid your normal Part B premium of $170, and your Part D premium would have varied based on the plan you picked. But you can see once you get to 91,000 and up to 114,000, now your Part B premium has just gone up from 170 to 238, and your Part D has gone up another 1240. So now you're paying 250 instead of the 170. And you can see once you go above 114, now you're paying $340 for your Part B plus $32 and so on. So, if you're making greater than 500,000 for an individual, your premiums are gone from 170 to 578 plus another 77. So now you're at like 650. So that's a pretty substantial difference in terms of the premium. Obviously, if you're a married couple, you double that if you're both on Medicare. So what we want to do is avoid falling into the next threshold. So here's an example for 2025. So the cliff for 2025 for a single person is $106,000. So if you make less than $106,000, your Medicare Part B premium is going to be $185 a month. And so that works out to $2,200 a year. So that's only about a 2.1% Medicare premium rate. However, if you're 106,001, you're now in the second tier. Your Medicare Part B premiums have gone from $185 to $259, $3,100 a year. And so that's a 2.9. So $1 of income just costs you almost $900 of Medicare premiums. And again, if it's a married couple, now we're talking $1,800 a year. So not an insignificant amount. So, if we're doing other planning, like maybe we're going to do Roth IRA conversions or something like that, we want to make sure that, $1 of extra income doesn't cost you an extra $900 in, it's not essentially a tax, but it's increased premiums on your Medicare. So that's IRMAA. The next one is Social Security. As I mentioned, Social Security is partially taxable. So a single person, if you make less than $25,000 of modified adjusted gross income, you don't pay tax on Social Security at all. Once you get to that $25,000 threshold for a single person or $32,000 for married, you pay tax on half of your Social Security benefits. So, if you have $25,000 of Social Security benefits and now you're subject to the 50%, we're going to list $12,500 on the form line 20A there of your tax return and list the total Social Security benefits and then the taxable amount. Once you get to $34,000 for a single filer and $44,000 for a married, now you're paying tax on 85% of your Social Security benefits. And that's the worst case scenario. So you're always going to get at least 15% of your Social Security benefits tax-free. And the good news for those that are in California is one of the rare tax breaks California gives us is they don't tax your Social Security benefit. But like IRMAA, $1 over throws you into that threshold. So you can make one extra dollar, and now all of a sudden you're paying tax on 50% of your Social Security benefits. So what we call that is the tax torpedo. And so we're going to be on the lookout for making sure that we don't subject you to the 3.8% NII tax if all possible, and doing everything we can to keep you below those IRMAA thresholds. And the Social Security tax torpedo, those rates are pretty low, but we do have clients where we're doing planning where, say, they're living off of cash or they're living off of Roth IRAs or things like that. We can keep it so their Social Security benefits are fully tax-free. And so there are planning strategies we can use that we'll implement when we run projections to kind of minimize those cliffs. So strategy number 2 is Roth IRA conversions. So we're big believers in what we call tax diversification. We want to have money in your tax-free bucket, which is typically the Roth IRA, in your tax-deferred bucket, which is typically your 401ks and your IRAs, and then also ideally in just a taxable bucket, which is a regular old investment account. And if we have tax diversification, then we can mix and match where we're taking from and optimize these tax rates. Excuse me. So one of the strategies we look at is, should we be doing partial Roth IRA conversions? So if you have a $500,000 IRA, we're not going to convert all 500,000 to a Roth and now subject you to the 37% tax bracket and IRMA and the NII and all of that kind of stuff. But what we want to do is just do little chunks. So the idea with a Roth conversion is we have a Roth IRA and we're going to convert small amounts over a long period of time and slowly move money from your regular IRA to your Roth IRA. So when you do a Roth conversion, you do have to pay tax on the conversion. So that's one of the things we have to analyze is, can we afford to pay the tax? Do we have the cash flow to pay the tax? What's the tax hit going to be? But once the money's in the Roth IRA, once you've owned the Roth IRA for 5 years and you're over 59 and a half, the money can come out absolutely tax-free. And so you don't ever have to pay tax again. So you essentially pay tax once on the conversion and you never pay tax again. So the way we kind of look at that is, now you've paid tax on the seed, but you don't have to pay tax on the fruit. The Roth IRA may or may not be better than, say, putting the money in a 401k or an IRA. We don't know because tax brackets change constantly. But the idea here is we want to hedge our bets and have money in both types of buckets so that when rates change, we can take advantage of those changing rates. The other benefit to a Roth IRA is you don't have required distributions at 73 like you do with a regular IRA. So it creates that tax diversification. Another benefit is when your heirs inherit the Roth IRA, they can take distributions tax-free as well. Where if they inherit your IRA, they're forced to take it out over 10 years, which is the same for the Roth, but those distributions are taxable in a regular IRA versus a Roth IRA. So the strategy here is to do partial, just periodic Roth conversions. We can do it every year. There's no age or time limit. You could be 85 years old and still doing Roth IRA conversions. The question is, does it make sense for you to do it based on current and future tax brackets? So that's where we would do the analysis. So to give you an example, let's say John has income of $30,000. So he's in the 12% tax bracket. So an extremely low tax bracket. More than likely, John will be in a higher tax bracket in the future as rates change, or he has to start taking required distributions, which forces him to higher tax brackets. So let's say the top of the 12% tax bracket is $40,125. So if we convert $10,000 to a Roth IRA, John's going to have to pay tax on that $10,000, but the conversion's still taxed at 12%. And so if that $10,000 in conversion grows to $100,000 in the future, there won't be any more tax to pay on that. So we've definitely leveraged the current low tax bracket by moving money into. And as I mentioned before, what we need to be careful of is we don't want to do so much that now John's not in the 12% bracket anymore. He's in the 22% bracket or higher. And then we also look at things like IRMA or Social Security, or if you're, getting your healthcare coverage and you have the premium tax credit, so it's being subsidized by the government. Too much income in a Roth conversion can make you pay higher medical premiums, and then also capital gains bracket. So there's a 0% capital gains bracket. So we don't want to do such a large conversion that, now we're causing these additional taxes and it isn't tax efficient to do it. So the way we do this is we pretty much run projections every year to see how much it makes sense to do, if any. And then the other trick is, okay, yeah, John, we want to convert $10,000. Do you have, the $1,200 plus, say, whatever the state tax rate is, to pay the tax, because you're going to have to pay the tax when you file your tax return or when we make estimated payments. But the idea is, if we can do these periodically over a long period of time, we can gradually move money from the taxable bucket to the tax-free bucket. You don't have to have your required distributions. Your heirs can inherit that tax-free. So there's a lot of benefits to doing Roth conversions. So it can be a very, very powerful technique, but again, it's just little chunks at a time over a long period of time where we gain that leverage. So the next strategy is tax loss harvesting. So the idea here is, let's say we have some stocks in your portfolio that have a loss because there's a market downturn. So, is it painful to sell a stock at a loss? Yes, it is. But we can take that loss and we can use that loss to offset other gains. So maybe you've got a stock that's down, but then you have other stocks that we need to diversify that are up substantially. We could sell the stock at a loss and use those losses to offset gains on other stocks. So we can always offset other gains. In addition, we can use up to $3,000 of those losses in a current year, and then anything additional we carry forward indefinitely. So let's say you had $50,000 of losses, and this is a technique we used substantially during COVID, where we had a major correction, but it was extremely temporary. So we sold a bunch of stocks, took those losses, and then the market rebounded, and we can buy back in those stocks, and then we have all these losses that we can offset gains again. So for this to work, if you're going to buy back the same stock, you have to wait 31 days. Otherwise, it's what's called a wash sale. But generally what we'll do is, for example, NVIDIA has taken a hit recently because of, it's had just a huge run up, and now there's this new potential Chinese AI stock. So we may sell out of NVIDIA and take losses if there are losses, and then we may buy a different AI stock that has potentially better upside and use those losses to offset gains on a different stock. So our portfolio manager's constantly looking at tax loss harvesting. It only works in taxable accounts. Obviously, it makes zero difference in an IRA, but in a taxable account, we'll use tax loss harvesting, gather these losses, and most of the time what we're looking at are temporary losses, or there's just stocks that we don't feel that they're going to recover, and there's more suitable replacements, and we can use that to offset gains on other parts of the portfolio. So we're very active in doing tax loss harvesting, and so our tax planners are working constantly with our portfolio manager to say, hey, you know what, Joe is going to need some money to put a roof on his house. We have these tax losses that we can harvest the sale of stocks to generate the liquidity, and so then we can sell some of those stocks, generate the liquidity, and not have a tax consequence to it. So next strategy. So if you have a business, whether you're a sole proprietor or whether you have a pass-through entity like an LLC or an S corp, there are lots of things we can do in terms of business planning. For example, we may want to buy additional property, computers, or whatever it is, and lump those together and take large expenses in one year where you have particularly high income. The other option is we can take those improvements or equipment, and we can depreciate them. If you're not in a fairly high tax bracket right now, we can depreciate them, spread that tax out, and use those depreciation deduction in other years where maybe you're in a higher tax bracket. If you're self-employed and you don't have another office location, we can take advantage of the home office deduction and deduct, say, a den or a study or whatever you have that you treat as your home office. Obviously, we can set up retirement plans for businesses. And again, sole proprietors, We can use very simple things like a SEP or a simple for, less complicated plans, or, we can use an actual 401k if we have large salary deferrals we want to make. And then for older people that are self-employed, we can use a pension and take very large tax deductions. You have a self-employed healthcare deduction, and then we can plan around the various types of entities. For example, C corporations right now have a 21% tax bracket. And, there are double taxation issues with the C Corp, but we can model, should your business be a C Corp or an S Corp, or should it be an LLC, or should we just stick with a sole proprietor? So we can do entity type planning and take advantage of the business deductions. And I mentioned we also have that qualified business deduction for pass-through entities, where we can take a 20% deduction against the income to kind of level the field between the C corporation, which got a very nice tax break, and the pass-through entities like the S Corp, which did not necessarily get the same tax breaks. Okay, so the next is tax saving vehicles. So, there's a variety of these. You have IRAs that you can make, contributions to. You may or may not be able to deduct them. Even if we can't deduct them, they can grow, tax deferred. You have the maximum 401k deferral, which if you're under 50, it's 23.5 this year. If you're over 50, it's 31,000. So again, if we're looking at things like getting you below the, the NII limit, we may want to max out your 401k. Another strategy we'll use is maybe we'll turn on your Social Security, even though you're continuing to work, because Social Security benefits are only partially taxable, 50 to 85%, not taxable in California. So let's say you're going to get, 30,000 in Social Security benefits. We may turn on that 30,000 of Social Security benefits and then have you defer 30,000 into the 401k. And so you're going to end up with the same amount of just, spendable income, but now we've saved at least 15% on your federal tax return on the Social Security benefit and 100% of that income for California. So, we can play around with how much should we be putting into your 401k. If you have a Roth version, how much should go into the Roth versus how much should go into the regular 401k. If you can make a deductible IRA contribution, should you make deductible IRA contributions? We can also do something called a backdoor Roth conversion, where we put the money in to the IRA as a non-deductible contribution, and immediately convert it to a Roth. So there's things we can do. Health savings accounts, I'll talk a little bit more about. They're the best tax vehicle there is. So if you're still working and you're under 65, this is a tremendous tax saving vehicle. And then for older clients, we'll look at things like qualified charitable distributions and how do we lower or freeze your required minimum distributions. So, required minimum distributions now kick in at 73, used to be 70 and a half. It's ultimately going to age 75. And there used to be a 50% penalty for not taking your required minimum distribution. It's been reduced to 25%. So that's more palatable. It's still, we don't want anybody to not take their RMD. And so the RMD applies to IRAs and other retirement plans like a 401k or a SEP or a simple, things like that. Doesn't apply to Roth IRA. So you don't have an RMD on a Roth IRA. So some of the planning we'll do around this is, if we just keep stuffing everything into the retirement plan, the 401k, the IRA, or whatever, down the road, you're going to be forced to start taking pretty significant distributions. And now it's out of your control as to, how much you're going to have in taxable income. So what we want to do before we get to the RMD age is, again, try and look at ways to freeze and minimize RMDs. And so it may mean Roth conversions. It may mean actually taking distributions from the IRA and the 401k prior to RMD age. And so do things like to try and invest more conservatively in the IRA and more aggressively in the Roth, and the IRA, the taxable accounts to kind of freeze the growth on the RMD. So there's a lot of planning we can do around RMDs. And then one of the things is the charitable IRA. So if you're over 70 and a half, and generally you're in an RMD situation and you're making charitable gifts, most commonly, what you do is you're going to write a check to your favorite charities, or make a donation at church or whatever you do, and then you're going to take your RMD. And so in scenario A, you accept your RMD and then you give the money away. So yeah, you may or may not get the tax deduction for the charitable gift, but it's increasing your total tax liability, which may trigger IRMA. It may trigger Social Security taxation, etc. So if you're going to have to take an RMD and you're going to make charitable gifts, what we propose is to make what's called a qualified charitable distribution. And so the way this works is if you instruct your IRA administrator to make a distribution directly to a charity, you satisfy your RMD, but you don't add your taxable income. So the way these work is you can transfer up to $108,000 from your IRA to charity. It counts as your RMD, but it's tax neutral. So there's no tax on the transfer from your IRA to the charity, but at the same time, you don't get a tax deduction. They're not going to give you a tax deduction if you're not going to pay the tax on the transfer. You have to be at least 70 and a half to do this. Most people, it's, you do it when you're taking your RMDs. So it serves a couple purposes. One is you're making your charitable gifts with the most tax inefficient money that you have. I mean, cash is tax efficient. You're not paying tax on cash. The IRA is going to be taxable, so you may as well give it to charity. Charity's tax exempt. They don't have to pay the tax on the IRA distribution. You would. So it's also freezing that IRA balance for later taxation. It's reducing the IRA balance, which means you'll have smaller RMDs in the future. So where we would use QCDs or the charitable IRA is you're making charitable gifts, typically of cash, but you're not itemizing, or even if you are itemizing, this still may be a more tax efficient way to do it. So this can be very powerful for those of you that are making substantial charitable gifts and you're forced to take RMDs. We generally are going to want to make that charitable gift from your IRA, not from your cash or other assets. So the next strategy is health savings accounts. And as I mentioned, this is actually the most tax effective vehicle there is. It's the only vehicle where the contribution is tax deductible. While it's in the HSA, it grows tax deferred. And if you take the money out for qualified medical expenses down the road, it's tax free. So it's essentially triple tax free. Now there's some caveats here. You have to, you can make tax deductible contributions, but it has to go into a healthcare plan that qualifies for HSA, which is what's called a high deductible health plan. So as long as you have a high deductible health plan, you can make a contribution to the IRA. There are contribution limits. As I mentioned previously, I'll just go back to that slide real quick. Let's see. Here it is. So for a single person, it's $4,300 a year. For a family, it's $8,550. So we can stuff a fairly significant amount of money in the HSA. And while it's in the HSA, most investment custodians like Schwab and Fidelity, et cetera, have HSA accounts that you can invest. You can invest it for growth and let it grow. And ideally, what we typically do is you're starting these fairly young, and we save that money, let it grow tax deferred, and use it in retirement when you're going to have higher healthcare costs. And so we can let it grow, say, for 10 or 20 years, and then you get to your 60s, and we can take it out to pay for your you know, higher healthcare costs, and it's tax free. So it's a great savings vehicle. Again, you have contribution limits. There's the max you can contribute. You have to be in a high deductible health plan. And once you hit Medicare age, you can no longer contribute. You can continue to have the HSA and let it continue to grow, but you can't contribute after Medicare age. So because it's such a great tax vehicle, there's some limitations on how much you can use. But again, if we can, contribute $8,000 a year to it and let it grow, ideally, that's what we want to do. A lot of people, they can put it in the HSA and then they immediately spend it on health saving, health expenses. Ideally, let's fund current health expenses from your cash flow and let this HSA grow as much as absolutely possible. Okay, so the next strategy is bunching itemized deductions. So at the very beginning, I mentioned when TCJA was enacted, they increased the standard deduction. They essentially doubled it. So for this year, if you're married filing jointly, you have a $30,000 standard deduction. If you're single, you have a $15,000 standard deduction. If you're over 65, you get an extra $1,600 per person. So a married couple over 65, they're $33,000. So the idea here is if your itemized deductions, which is your state and local taxes, so your property tax, your state income tax, your DMV fees, your mortgage interest if you have mortgage interest, your charitable contributions, and your medical expenses, which have to be above 7.5% AGI. If those itemized deductions don't add up to more than that 30,000 or 15,000, we're not itemizing. We're just taking the standard deduction. So there's no benefit to itemizing. So the strategy here is to, particularly for medical and charitable deductions, because those are the two you can control, let's bunch them together. For example, let's say you're going to have a medical procedure and a dental, maybe you need dental implants or whatever. So you're going to have substantial costs. Typically, maybe you did one, in 2024, and you did the other in 2025. What you may want to do, if possible, is bunch those together into 2025, where we're going to have significant medical expenses that we may be able to deduct. And the other one, obviously, is charitable deductions. We can lump charitable deductions together to be able to itemize in certain years. Typically, we're going to do this through what we call a donor advised fund, where you're going to make a very substantial donation in 1 year. And then from the donor advised fund, you can make your normal charitable gifts each year from the donor advised fund. So I've got an example here on the next slide. So here's on the left in the blue is a normal scenario, right? You're going to give $100,000 to charity over the next 4 years. You made some kind of pledge. So you have your state and local taxes, and that could be $100,000, but it's capped at $10,000. So you have your charitable deductions of $25,000. We assume no mortgage interest, so your total itemized deductions are $35,000. The 2024 standard deduction was $29,200. So we're going to take the higher of the itemized or the standard deduction. So we're going to actually deduct $35,000. So we go to 2025, we assume the same set of facts. The standard deduction actually increases. For example, this year it's $30,000, but we assumed it stayed static. So every year we're going to deduct $35,000 instead of the $29,200. So at the end of those 4 years, we've deducted $140,000 of itemized deductions rather than the $116,800 of standard deductions. So we took an extra $24,000 of deductions of those 4 years. Now, if you look at the orange on the right, the SALT's going to stay the same. It's capped. But instead of making 4 $25,000 gifts, what if we made one $100,000 gift to a donor advised fund? And then from the donor advised fund, we'll make those $25,000 gifts to charity each year. So now for 2024, our itemized deduction's $110,000 rather than the $35,000 in the prior scenario, and rather than the $29,200 in the standard deduction. So for the next 3 years, we're not making any charitable donations. So we're going to take the standard deduction, $29,200 each year. But if we look at what we actually deducted We deducted 110 year one, 29.2 year two, 29.2 year three, 29.2 year four. We actually deducted 197,600 versus the 140. And so, this is an example of how, you're going to make these charitable deductions anyway. You have the cash flow to do it in 1 year. We can bunch those together using a donor advised fund. And we just took almost an extra $60,000 of deductions, which at a $30,000 or 30% combined tax bracket, that just saved $18,000. We can do the same thing with medical expenses. And, we could, rather than doing 100,000 in 1 year, maybe we do 50,000 1 year, zero the next year, 50,000 the next year. And the result would be similar in that you'd end up with higher deductions. So these are the kind of things we have to look at. Every one of your situations is going to be totally different. And that's why we have to do the tax planning and we have to run projections to see which of these strategies is going to work for your individual situation. But kind of the concept here is we're probably likely going to be able to continue with these fairly low tax brackets, for the near future. I guess we could end up with gridlock and TCJA sunset. Our best guess is it's going to be extended. It may only be a year that it gets extended, but the can's going to get kicked down the road for a while. So these are the kind of strategies we're going to use based on the current tax laws. And then estate planning. So the way it sits right now is under the TCJA, each person other than non-citizens has a $13,990,000, or essentially a $14 million exemption from gift and estate tax. So if you're a married couple, unless you're worth more than $28 million, you don't need to worry about estate taxes. California does not have a estate or inheritance tax, so we don't need to worry about California. Certain states, for example, Washington, only has a $2 million exemption. So there could be situations where maybe we have to do estate planning for particular states. So what would happen if the TCJA sunsets? It would revert back to 5 million index for inflation. So it would be roughly $6.5 million to $7 million would be the exemption. So even at those levels, a married couple, we're still looking at $14 million. So the vast majority of people are never going to have to worry about estate taxes unless you live in one of those states that has an estate tax. But that doesn't mean we still don't need to do estate planning. There's all of the non-tax reasons, efficient disposition of the estate, creditor protection, divorce protection, all of those kind of things still require us to do will and trust and power of attorney planning and all of that to avoid probate, to protect assets, etc. But the planning that I used to do in my prior careers, where we were trying to save multimillionaires and billionaires millions of dollars of estate tax, it's not applicable to most people. We can certainly do that kind of sophisticated estate planning if needed for your situation, but for most everyone, it's just making sure we have an up to date estate plan in place. So the last thing I wanted to talk about before we open up for questions is the Social Security Fairness Act. So the way this works is you have certain sectors of employment, primarily teachers and educators and first responders and people that work in the government, that don't pay into Social Security. Instead, they receive a governmental pension. And so you'll have situations where maybe you worked in Social Security and out of Social Security. So the way the Social Security rules were written, it assumes lower income people get a higher initial benefit than someone who makes more money. And so people that didn't work much in the Social Security system are shown to have a lower wage base. And so they got the benefit of this higher first tier of Social Security benefit. So the government enacted these two provisions, the windfall elimination provision and the government pension offset, to in theory, level the playing field between people that got a pension and people that had Social Security. So the way this worked, for example, the windfall elimination provision, you could have if you're receiving Social Security benefits and you work both in and out of Social Security, you could have your benefits reduced by as much as $613 a month. So if you say you're technically entitled to, $1,000 a month in Social Security benefits, you were subject to WEP, you were only going to get $387 of Social Security benefits. And it's even more onerous for survivor benefits because the survivor spousal benefits are reduced by 2/3 of the pension amount. So let's say you're getting a $100,000 pension and you're getting $24,000 of Social Security benefits. 2/3 of the pension is $66,000. Essentially, that surviving spouse would get no Social Security benefits. So WEP was onerous, but you could still actually get some kind of benefit. GPO survivors may not get any kind of Social Security benefits. So the good news is these two laws were just repealed with the Social Security Fairness Act. So this was essentially just enacted towards the end of last year, and they've been repealed back to January 1st of 2024. So if you're subject to these, and you may not even be aware you're subject to them. So if you worked both in and out of Social Security, you're going to see these reductions taken off of your Social Security benefits. So you'll see increases in your Social Security benefits, and they're effective back to January. So you will see, in all likelihood, a lump sum payment for 2024. Now, this is brand new, and Social Security, hasn't figured out how they're going to do all this. So I wouldn't expect you to start getting these retroactive checks in the mail anytime soon. It may take several months. Also, the Social Security Administration has just been deluged with people calling about these changes. So if you're going to try and get a hold of the Social Security Administration to get answers, you're likely not going to get a hold of them. I was on the phone with Social Security the other day for over 2 hours, and I never got through to anybody. So the good news is, if you're subject to these, and if we're aware of it, we'll certainly discuss them with you when we do your reviews and your tax returns. But you should see increased benefits, particularly for those surviving spouses that were dramatically affected by the GPO. So we'll keep you posted on any new developments in terms of when these payments are going to be made, when you could see them, in terms of checks and et cetera. And if you have questions about them, we'll try and answer them as best we can. As I mentioned, right now there aren't a lot of details, but that's kind of what we wanted to cover today. So hopefully we covered a lot of the things you were interested in. If you have other questions, I'm more than happy to take those questions at this time. You can just put them into the Q&A feature, and we'll go ahead and start taking those. So let's see what we have here. Any questions? Do you audience questions? No audio. Okay, so were people having problems with the audio? Looks like I had a couple people say that they had issues with the audio. Everybody else, if you could hear it, maybe give me a thumbs up. Okay, so I've got a question here with you're talking about, I assume, the HSA. How old must you be to start contributing? There isn't an age. If you have a high deductible healthcare plan, you can contribute. So a lot of times, if your employer may offer the HSA and they may make contributions, And so you just have to be cognizant of the maximum contributions. For example, like, if it's a family plan, that $8,300, you have to make sure you don't exceed that. So the only restriction is once you hit Medicare age, you can't contribute anymore. So once you hit 65, you can't contribute. You can continue to have the HSA and use it, but you can't contribute. So ideally, you start as early as possible so you can, build up funds, because again, the contribution limit's fairly low. So, we want an extended period of time to get enough money in there to let it start compounding. Do we have any other questions? Okay, so as I mentioned, this was recorded, and so once it's available, will be posted on our website, we will let you know. And so, if you had problems with the audio or whatever, oh, okay, we have a question here. One sec. So the question is, you joined late. Are the Trump tax cuts being extended? That's our best guess. No guarantee. It requires the approval of Congress. And as I mentioned at the very beginning, there are even Republican congressional members who are not keen on, extending the federal deficit larger, because these tax cuts are going to create an even bigger budget deficit. But our guess is, yeah, they're probably going to, at a minimum, kick the can down the road for a year. So we'll keep you updated, through the year. At the moment, there's no pending legislation of any kind. It's just too early. And if this goes anything like the last several times where we had, the potential sunsetting of a tax act, the last one we had what we called the fiscal cliff. They essentially got that done on the 29th of December. So we shall see what happens, and obviously we will keep you guys, educated on what's going to go on. So, any other questions before we wrap up? Okay, so we're just about to the end of the hour. I appreciate everybody listening. We will have another webinar in February. It'll be the last one until we go dark for a couple months due to tax season, and we'll announce on our newsletter next week what the February webinar will be. Hope everybody has a great evening. Obviously, if you have additional questions, you want to talk about any things, you can reach out to me. You can reach out to Blake Pinion on our team, and we're happy to discuss this stuff in more detail. All right, guys, everybody have a great evening. We'll talk to you soon. Thanks.